In this summary, we'll look at 3 significant points from the very highly rated book, The Bogleheads Guide to Investing. The teachings are from legendary investor John Bogle, founder of the Vanguard Group. John Bogle made investing more accessible and less expensive for individual investors through index funds that track the overall market. Imagine starting at the age of 25 and becoming financially independent by the age of 65. Will you choose to save and invest, or join the majority who prefer to borrow and consume? Save and invest early and consistently. The Bogleheads mention that it's essential to be a keeper, which is someone who invests and pays themselves first. Paying yourself first means setting aside a portion of your income for savings and investments before paying for monthly expenses. It's critical to have a plan and an up-to-date monthly budget to allocate funds for retirement investment. Before you begin investing, here are 3 crucial steps recommended from the book. Step 1. Change your mentality from focusing on paychecks to net worth. Look at how much of your income you can keep and build over time rather than focusing primarily on income. Step 2. Pay off credit cards and high-interest debt. It's easier to fall into the trap of borrowing large amounts you cannot pay off before facing high-interest rate repayments. Step 3. Create a safety fund by setting aside money in case your investments don't perform. Having 3 to 6 months' worth of expenses saved provides a safety margin to ensure you won't face unexpected financial challenges. The next step is to click the like button if you're enjoying the video because it definitely helps. Cheers! Keep it simple. An essential principle in the book is to keep investing as simple as possible. Complexity can often lead to worse decisions, as portfolios with stocks in many different industries can be tough to track and understand. Instead, by investing in an index fund, an individual retail investor can gain from the benefits of diversification without the complexities. The book's primary thesis is that with little effort, retail investors may get average market returns that outperform most professional funds. The claim is to achieve this through index fund investing, as it requires little knowledge, skills, and barely any time. Index fund investing allows people to spend more time on other parts of life while still being able to outperform most professionally managed funds. Instead of wasting time attempting to forecast short-term market fluctuations, we may put our time to better use. The power of index funds. Index fund investing offers a chance to buy into various shares representing the entire market. As a result, we may be able to benefit from well-diversified returns provided by corporate earnings growth and dividends. But why are index funds so popular and effective? The answer partly comes from very low costs. When costs are taken away, most active fund investors make less than average index fund returns due to the high management fees of active funds. However, many popular index funds offer low costs, such as the Vanguard 500 fund, which tracks the S&P 500. Index funds have fees, but often they are less than 0.4% compared to active funds, which are often more than 0.8%. The difference in fees may seem small, but it can add up when compounded over more extended periods. Additional benefits of index funds over active funds include lower taxes and no concerns about the potential performance of active fund managers. Asset allocation based on your requirements of investment holding period and risk tolerance is key. Your ideal asset allocation is a mix of high-risk and low-risk investments that give you the overall return and risk you require. The Bogleheads give portfolio guidelines that vary depending on your stage in life. As you get older, your portfolio allocation will likely shift to lower risk and lower volatility assets. Once you've established your asset allocation based on your requirements, tracking your performance and rebalancing your portfolio is essential. Rebalancing aligns your portfolio with its initially planned asset allocation, which helps balance portfolio risk. The process involves selling the higher performing assets and buying underperforming ones, effectively buying low and selling high. Setting up a plan to check your portfolio when specific imbalances occur is crucial. You can use a percentage or time-based rebalancing criteria. For example, you can rebalance if your asset allocation changes more than 5% from the original asset allocation, or use an annual rebalancing strategy. It's also crucial to manage our emotions, as greed and fear are particularly common emotions that influence investors to buy high and sell low. To overcome this, it's essential to filter out distractions from the media and what others are doing to avoid mindlessly following the herd. Forecasts and investment media programs are there to build our emotions, grab our attention, and not necessarily provide rational advice. If you're looking for ways to increase your rationality toward investing, check out this video here about Warren Buffett's investing principles. Two common emotional pitfalls are overconfidence and loss aversion. Overconfidence can make us think we have great stock picking and timing skills. The stock market is a costly place for overconfidence, as none of us have a crystal ball for knowing what will happen in the future. It's good to have a balance of confidence and humility while understanding that no one can be certain about the market's movements. Remember that mastering your investments entails mastering your emotions as well. According to the writers, the key to compounding long-term development is to start investing early and consistently. Make sure you look at age-appropriate asset allocations by diversifying into lower and higher-risk assets. While the authors agree with Bogle on many points, they have different views on international investments. Contrary to Bogle's opinion, the authors think that a more extensive 80 to 20% equity holding in international stocks is ideal. They think a larger amount is beneficial because they feel emerging market stocks present lower valuations with greater growth potential than developed markets. Additionally, they mention the demographic advantage of emerging markets having a younger and hard-working labor force, which can result in faster economic growth. The investing principles given in the Bogleheads guide can be utilized to support and steer discussions with a professional investment advisor. If you liked watching this, please check out this video about John Bogle here. Please consider subscribing and click that like button because it helps. Cheers.